Illiquid, right? Not necessarily liquid. So how does that fit with his strategy, with the Balco's strategy?
Well, I think he can take advantage of that when buying, but in selling, I don't think it reaches a bank capital on the side for that.
What allows you to overcome illiquidity? Yes, Nate.
Excess capital. His access to it,
Sustainable
so
source of capital.
he doesn't necessarily need to get out right away.
Yes. The only antidote to illiquidity is your ability, your staying power, which is essentially capital, right? And this is, those who fail are the ones who bite on too much relative to the capital base they have. Okay. So real estate is one of the many asset classes that Balco's invests in to achieve its mandate. Like any asset class, real estate can be attractive investment at two levels. One, if you look at Exhibit 1 of the case, it suggests that a broad exposure to real estate is an effective diversifier. Okay, so let's look at Exhibit 1. If you see what is in that exhibit that tells you it is an effective diversifier. Yes, Alex. Yes, the third table at the bottom. If you look on the left side, NCREIF Property Index, which essentially is the private market index in the United States. I don't know why they gave this in this case study, because they should have used London Index, right? Which is IPD index rather than NCREIF Index. So, and the correlations are very low with large cap equities, with mid cap equities. It's negative with treasuries and corporate bonds. And hedge funds is also all, the correlations are very low. How does it help to have low correlations? How do low correlations help? Diversification? Yes, yes. So, between 1978 to 2016, the broad exposure to real estate delivered if you look at the Sharpe ratio, which is on the top, right, in the first table on Exhibit 1, the Sharpe ratio was, which is 0.49 for NCREIF, was very similar to 0.48 for S&P 500. How many of you know what a Sharpe ratio is? How many of you don't know what a Sharpe ratio is? Sharpe ratio, you, Alex?
No, not well enough to explain it.
No. So let me explain. This is important concept. Brenda, do you know what Sharpe ratio is? What is it?
The return that you get for the risk that you obtain, something like that.
Yes. The holy grail of investing for larger companies is this. The expected return minus RF. This is what? What is this called? If you make any investment in any asset and your expected return from that minus the risk-free rate is called what?
Excess return.
Excess return. Very good. Excess return is proportional to what?
Volatility of returns.
The excess return on the market. Excess return on the market. Okay. Now, why is this? Why is this? Who knows? Who can? If you go back, you all know capital asset pricing model. Who doesn't know capital asset pricing model? Or is it? Everyone knows capital asset pricing model? No? So raise your hand, no? Raise your hand. Okay. It has been traditionally the biggest problem in investing has been what expected return to get from any investment you make. Right? the Greek ship sailed from Athens to Sicily, and the risk of the ship was compensated by, some 30% interest to compensate, but that was all arbitrary. When you take on a certain risk in a security, how do you know how much expected return to get? Now, there was no theoretical way to think about to get to that point for any asset class. Okay? Then came along these guys called Pharma and French, Chicago school. They came up with this idea. But before Pharma and French, there was this guy called Harry Markowitz. Have you heard of Markowitz? Those of you who have taken portfolio analysis must have heard of Markowitz. Harry Markowitz won the Nobel Prize in 1972 for his mathematical representation of how diversification works. Okay? So think about this. Let us say you have one stock. This is your risk, and risk is measured by what? What is the measure for risk in finance? Volatility. Standard deviation, right? Standard deviation. Now, here, number of securities. If you have one security, you will have some yes, if you have one security, your risk will be somewhere.
Sorry, where is that?
Right. Now to your portfolio, you add another security, right, which has a low correlation to this security. What happens to the overall risk of the basket of two securities? It goes down, right? What is being, and so something has reduced. The risk has been reduced, but what risk has been reduced? Say that?
Systematic risk.
No, the idiosyncratic, the firm-specific risk. Idiosyncratic risk, which is basically, let us say you have an umbrella company and you have a sunscreen company. When it rains, people buy the umbrella, so the price of the umbrella company goes up, and when it is very sunny, people apply sunscreen, so the price of the sunscreen company goes up. And if you hold both the company stock in your portfolio, you will even out, right? That is the theory of diversification. So what they saw was, as you keep increasing the number of securities, what happens is, with the increase of the number of securities, the standard deviation of the portfolio or the volatility of the portfolio keeps going down. Okay? As you increase the number of securities in the basket, but what does not get eliminated? All the idiosyncratic risk, which is the or firm specific or business specific risk, gets eliminated, netted out as you increase the number of securities in your portfolio. Okay? But then what remains here? This. It doesn't go below this, it just stabilizes, plateaus here. So what is at the bottom, which cannot be diversified away, is called systematic risk, right? This is the market risk. Now, this is your firm. Let's say you buy a real estate company or you make an investment in a property. That is the idiosyncratic risk you are taking, right? And as you build up your portfolio, you can diversify as much of your idiosyncratic risk as a real estate investor. But if, let's say, you are a sovereign wealth fund who has lots of money, or your CalPERS on CalSTRS, lots of you have to diversify. Then you look at stocks, bonds, real estate, private equity, gold, metals, and all that good stuff, right? So all that, by increasing that, they reduce their firm-specific risk. And a large diversified investor, therefore, who has all this, most of the securities in the world in some form or fashion, effectively is only left with the systematic risk. This is the risk of the market, like interest rate risk which is beyond your control, which you cannot diversify away, right? Non-diversifiable risk, which is this one. So the theory is this: as an investor who has diversified away all the idiosyncratic risk and is only left with the market risk, if they were to now think of investing in a new company or a new asset or a new security, what would they care about? Would they care about the firm-specific risk, or would they care about their contribution to the market risk of the security, right? So they have diversified away all the firms. So any incremental new investment is not going to diversify them anymore on the firm-specific risk side. So they care about how much the excess investment on their investment is proportion to the excess return on the market, because this is the market risk they are dealing with. The firm-specific risk has been diversified. Does that make sense? Right? Yes, no, yes, no. Who doesn't make sense to? Have I lost you, Brenda? Okay. So when you, now we have a, what is this? This is effectively an equation of a proportionality is always an equation of a straight line. Okay? It could be a curved line also, high school math. So if you can say is equal to some constant, right? Let's say beta. This constant, the excess return on your new investment by an investor who has fully diversified away their idiosyncratic risk is proportional to the excess return on the market, because they care only about the return on the market. How does this security behave relative to the market? Okay? And that beta defines that relationship. Beta effectively is the covariance of this security's return to the return on the market. Okay? So now you rewrite this equation, it becomes like this: expected return is equal to risk-free rate plus beta times RM minus RF. Does it remind you, this equation? What is this equation called? CAPM, capital asset pricing model. So that is the underlying thought process where capital asset pricing model comes from. The relationship between this excess return to this. And beta, we just saw, is something that ties the two together. For larger companies, this relationship holds. Right? With some error, of course. Error will always be there, otherwise it will be a very certain word. So the question then is, what is this beta? What is the beta? Beta is the factor that equates this side of the equation to this side of the equation. Right? With some coefficient here. So conceptually, for you to price the expected return on a security, what you can do is this. The next step is we use the basic techniques of statistic. Let us say this is your return on market and this is your expected return on, or not expected return, just the return on the security. Right? Let me just write to simplify expected return. That's fine. So now, let's say you are in the real estate asset class. Historically, you have looked at what happens to expected return on a security on a day relative to what happened to the market, how the returns were matched. So what you would do is, you will find a point on day one, perhaps, when this security went up like a few points here, the market went up like this point here. So this is, you're plotting the returns, right, between the two. And let me just draw this. And there'll be some points here, maybe some points here. So effectively, you have plotted for each day of your observed returns in the past, what happens to expected return from this security relative to the expected return on the market. So you have lots of historical data points to map out this relationship. And then what you do is you draw a straight line, which is called a line of regression, the best fit line between the two. This best fit line is what? It shows that if you were to draw a line across from somewhere these points, the sum of the squares of each of these points that deviated from this line would be minimal. That is the line of best fit. And that minimality is measured by what is called R squared. R squared, the higher the R squared, the better the fit. Okay? If R squared is 100%, that means this equation will be exactly like this. And how? How so? The slope of this line,
Beta.
is called beta. Okay? So beta measures historically on a rolling basis how this security behaves relative to the market. And you can plot that against RF. You can plot it against the excess returns on the market and excess returns of this. So effectively, that is exactly what that equation is saying. Does it make sense? Okay. So the beta effectively is the covariance. This is the covariance of the security excess returns with the excess return of the market. Okay? That is the whole idea. Now, the idea of a Sharpe ratio, that's where we were going with this. Okay. So this is the excess return on the security. As an investor, you could have 15 different options to choose from, and based on historical information, you can have 15 different expectations of returns of just this part from all the 15 different investments, because you have now mapped out what your expected return is going to be. And then you can calculate by using the risk-free rate what your excess return could be from all the 15 securities. So the question is, the one that has the highest excess return is the investment that you should make. Right? That would be your natural intuition. You invest in something where you would get the highest excess return. You care about excess return because excess return is net of the risk-free rate. As an investor, astute investor, you care about excess return, and that too real excess return. Okay? Now, so you have 15 different investments with different excess return profiles. Your expected excess return is X1, X2, X3, X4. How do you choose which one is the best? Your natural intuition is to say what? Invest in the one where your expected return is going to be the highest, right? But then there was this guy, Pharma in French. Sharpe, Bill Sharpe. Bill Sharpe came out and said, this by itself doesn't tell you much, because investing in real estate, investing in blue chip stocks, investing in small cap stocks, investing in bonds, they have different characteristics and flavors. So returns by itself don't say unless you factor in what is called the risk. And that is where the term risk-adjusted returns came about. And risk-adjusted return, if you were to look at this return and adjust it for risk, what would you do? You would say risk adjusted return is equal to excess return on your expected excess return on your security divided by sigma. Sigma is the risk. It is the standard deviation. Everyone familiar with standard deviation? Yeah? What is standard deviation? Yes, it is the square root of your variance, right? Okay. So this is effectively what is called the Sharpe ratio. Sharpe ratio, because it adjusts for the volatility of that security in which you are investing across the 15 securities, gives you one benchmark which you can compare. Returns by themselves don't tell you much, but returns adjusted for risk can be compared and contrasted against each other. That is what Sharpe ratio is. Okay? So on the one hand, low correlation. When two securities have a low correlation, they have better diversification properties. Okay? Because umbrella company and the sunscreen company, very low correlation, but almost perfect diversification, right? So investors who have large portfolios always prefer low correlation investment. That's how these guys at sovereign wealth funds, scalpers, they make a decision. Now, this time period includes a variety of different macroeconomic. If you look at this exhibit 1, they cover a period of 78 to 2016, which is a substantively long period, right? It has gone through different macroeconomic environments, including the stagflation and very high normal and real interest rates of the late 70s and the early 80s, and the real estate crash and the financial crisis of 2008, 2009. All that is covered. Plus mispricing from an active investment firm like Baupost, real estate is also attractive as an area where investing in individual assets can generate outperformance. Why is that? What allows you to make investments that can generate outperformance? What is outperformance in the first place? When somebody uses the word outperformance, what does that mean? Yes, Nate.
Stronger than the average of the market.
Yes. In this case, the average is relative to similar kinds of assets, right? Outperformance means when you can beat the returns from what, if you were to just be invested in that same asset class. Let us say you have a basket of 15 REITs, for example, right? Just go to the public sector. So you have a basket of 15 REITs, and you have to buy the 16th REIT somehow. You're thinking of investing. Right? How do you benchmark yourself? You look at the historical returns of those 15 REITs, or maybe or an index which, let's say the 15 REITs are in a part of an index, right? And then you invest, and if your expected return is more, or you perform better than them, that is your outperformance. Let us say the basket of 15 stocks generated a 15% return, and your return was 18%. So what is your outperformance? 3%, right? This name?
I'm just confused why they would compare it only to real estate. If they can get, if they're going to outperform all of real estate, and the average real estate's going to do 5%, they're going to make 8%, and everything else they're investing in their portfolios at 50%, then isn't the outperformance irrelevant?
Or diversification. Diversification purposes. Plus, in the case of Baupost, the thing is, sometimes they don't really care too much about diversification. They start with a different premise, which is there a margin of safety? So you can build an edifice not based on diversification, but build an edifice of the different investments which are based on the margin of safety, right? So you ultimately, if you look at the whole portfolio, there will be some diversification, but the portfolio itself will have so much, which have a huge moat by itself. A lot of things will have to go wrong for the investor to lose money. Right? Principal protection should be your first target. Even when you are young. There is something called life cycle investing. Many people say when you are young, you can take a lot of risk. When you become old, then your risk appetite goes down and you invest in low risk assets. Okay? So, I think that's a little too theoretical. The way to think about it is, even when you are young, if you lose money, it will be difficult for you to recover. So you have to construct your portfolio in a way that allows you a larger core to be safe, and then wait, maybe hold on to some cash, and wait and invest when it's like, the cheetah or the tiger in the forest, or the cat when the cat waits for the mouse to come. The market will fall apart someday and you will get tons of opportunities. The problem is most people are fully invested, they don't have the cash to benefit from the opportunities that the market offers. They don't have this problem because of what was explained about the relationship with investors. Right? Klarman views real estate as an area where it is possible to find large mispricing because individual properties are idiosyncratic and illiquid. So the illiquidity and idiosyncraticity itself offers potential for value creation for them. They are able to generate outperformance for its clients while maintaining a margin of safety. Okay? The firm focuses on real estate opportunities caused by capital market cycles. That is the other thing, right? There is a book you should all read. It's by Howard Marks. Huh? Kevin, you're smiling?
No, I had a feeling you were going to say that. I was thinking the same thing.
Yeah. What is the name of the book?
I forget that.
Benefit from the market cycle or something. Okay. Howard Mark is the head of Oak Tree Capital. Very astute investor, and read his book. If you get a chance, not now, but when maybe a beach read. And it views its ability to source such opportunities with local partners around the world as a major edge relative to their other investment firms. Other firms want to be in a market, they want to do everything by themselves. These guys say, we know what our strengths are. We know what our investment strategy is, what are the box within which we work. We will not go beyond our investment definition and strategy. And then that allows us to be more flexible and go out and meet different potential partners, operating partners around the world who can find us those opportunities. And they have a skin in the game and we will fund them. This includes Dr. Ingo Wolfs, right? It's a very similar business model. Okay. The deal fit. He believes Baupost has several other edges over other investment firms in reaching a deal for some parts property because of its abilities to rapidly analyze and value highly complex deals. Imagine you're sitting in this firm. How many people in this firm do you think in Baupost?
300.
Sorry?
300.
I don't think so. I think that's the question that the managing partner of this, who did the deal, that's one question I forgot to ask him. Maybe it's in my notes somewhere. I think it's less than that. It's around 30, 35. His name is JJ.
Online it says in 2012 it was 42.
14 people.
42.
42, yeah, 30. So, okay. Very good. They structure deals to attenuate risk, and we will see how they do it. Fund deals when liquidity has dried up. You never make money when everybody is making money. You only make money when everybody is completely exhausted and you still have the investment vigor, you can pursue it further, right? And that's the other thing. So you look at markets where there is a problem with liquidity. Heinz went to Rio because there was a liquidity problem in the market. And we will see other such cases. Moreover, its long-term investment horizon means that Baupost is willing to undertake an investment with 8.5 years, 8+ years before main cash flows will be realized. How many investors do have that appetite? If somebody tells you give me the money now and I'm going to give you 8.5 years later, what will you think? You think you're crazy,
See it.
right?
You might not even work there anymore.
Sorry?
You might not even work there anymore.
Yes, yes. Depends on the investors also. I still have no CD times after all these things. So, whenever you'll probably all start funds and just, some investment activity, one of the most important things is for your investor to see some money from year to year. If they don't see money, or if you imagine you put $100,000 in your account, brokerage account somewhere, and for like 8.5 years you don't see any money, what will happen? You'll go crazy, right? So we will see this when we do Pro Invest, the next case study, or not after Equity International, we do Pro Invest, right? How do you psychologically treat your investors? You want to give them some capital return, just to make them psychologically happy every year. Even for real estate fund with 5 to 10 year life, St. Bart's project would be difficult to undertake because its cash flows might not materialize before the end of the fund's life. This is their comparative advantage. When the other funds, including the private equity funds who have how much years of life? 7 to 8, 9 years, right? You can digest 8 plus years of no cash flow, which no other private equity fund can compete with, because they have to go through the whole investment cycle within 7 to 8 years. So when you think about your entrepreneurship projects, you should have a clear idea of how you're going to be comparatively different than most of your other competitors. How are you going to achieve that? In contrast, Baupost does not need the cash flow to realize before a particular date, so long as they generate a sufficiently high return, total return. The case tells you they don't work on relative return, they work on absolute return. Is everyone familiar with the difference between relative and absolute return? Most investment managers, when they manage money, their performance is measured on a relative basis, by how much they beat the market. So all the investment managers, ultimately, what they try to do is, they try to, as a result of the incentive, the way they are set up, is invest in the mainstream and perhaps take a little risk on the side to show that you beat the market. Okay? And they get compensated as long as they beat the market. For these guys, including Mr. Buffett, they don't get compensated until they have absolute return. So what's the difference? Let's say the S&P 500 in a relative measurement, S&P 500 goes down by 15% that year. And you as an investment manager, you went down by only 12% a year in that year. So your relative performance is still 3%, right? Which is, you beat the market by 3%. But you lost money, but you beat the market. Right? So that is relative investing. Absolute investing is, you don't get paid if your returns are below 0%. You have to, irrespective of the ups and downs of the market, you have to show positive returns. Now, you can structure an investment proposition as a company where you have to show absolute returns, but if the market performs positively, you still have positive returns also. That combination, right? Very powerful. While the St. Bart's project is not outside St. Baupost deal-making abilities, the firm recognizes it does not have the capability to plan and execute the redevelopment itself. This is the primary reason they are partnering with Helical Bar. Helical Bar also sourced the deal for Baupost, right? So it helps you. What is the story with Helical Bar? Yes, Nick?
You're a public company, so I guess from looking at their financials and their track record, they're fairly transparent, but they like them because they had an entrepreneurial spirit set, so I guess that's probably not as common from a public trading.
Why is it it not common?
I guess a lot of publicly traded companies can be adverse to risk because of the responsibility of their shareholders and the way it affects their stock price.
Yes, yes. They get killed if, and the stock gets badly hit if they try to be too entrepreneurial. That's why all the REITs, which are public companies, when they have to do low risk projects, income producing projects, they put all those assets on their books. And when they have to take on a little bit more risk, these development projects, they do it in the form of joint venture, where they have, some investment in the joint venture, but when the asset is ready and fully prepared and fully developed, then they buy it and then put it on the asset base of the REIT to show that you have low risk. Okay. The same part still fits the mold for Balcos because obviously the charity is a motivated seller. Real estate is in a period of distress, and central London is more robust market than most others. Right? It's a confluence of factors. Great, as many of you said, great asset, liquidity issue, and a unique situation where the seller is highly motivated. St. Bart's offers prime real estate in one of the largest, most dynamic cities in the world. You all said that. The property sits in the heart of financial district. So what are the risks? What are the risks? Yes, Victor.
Currency fluctuation because most of the investors sit in the US, so if the pound devalues, so the returns might set against the US dollar.
Okay, so I'm going to erase this, we don't need. Currency, what else? Currency. Risks. What else? Yes.
Time.
Sorry?
Time.
What about time?
Well, in many ways, there's how long St. Bart stays in the space if they're not ready to leave.
Time of development, right?
Yeah. And there's construction schedule that could be delayed as well.
Potential delays. Okay, Kevin?
I don't think they're officially approved to turn into a mixed use yet.
See that?
I don't think they're fully approved to turn it into a mixed use yet, so there's some risk in that
I
process.
can't hear you, my friend.
I don't think they're officially approved to turn it into a mixed use yet. So
They
there's-
don't have the approval yet,
Yeah, so
right?
there's some risk in that process.
Okay, approval risk. Nate?
There's like, it kind of goes back to time, but kind of demand risk. So they said that they thought the demand was high right now, but 5 years from now there might be more supply or the dynamics might have changed. So
Demand risk.
that goes to time as well. But yeah.
Okay, Austin?
Just the issues with the site itself. I guess it kind of goes with approvals, but there's also environmental risk, historical issues, possibly.
Environmental, archaeological, right?
Probably structural risks as well.
Structural. Cyrus?
Currency risk.
Yeah, that's the first one we have.
I was kind of confused on, I didn't understand how they mitigated it. If you could explain that further.
Yes, we'll deal with it.
Sure.
Yes, Anmol?
Estimating your cost of materials far in advance before you actually.
Okay, construction risk. Construction risk. Okay, and if you're thinking in terms of the cross-currency implication of the construction risk, which is covered in the currency here. Who else? Mr. Shi?
It's a new partner for the
Oh,
purpose.
new partner risk. What other risks do you think they have? Yes, Taylor.
The possibility that the tenant wouldn't vacate after the lease is done, that would cause negative risk.
Yes. Seller not vacating. Yes, Cyrus?
Kind of goes with the seller not vacating, but then how they talked about the high profile nature of the tenant and kind of a PR they need to be careful on not.
If they don't vacate, you can throw them out, right? It will be a bad thing in London. So, PR risk. PR risk and obviously the financial risk that goes with this. What other risks do you have? Yes, Nick.
They identified that the residential component was the main driver of return this project.
Yeah.
And first of all, there's no residential in the area, so there's no, like, the demand hasn't been tested. Second of all, there's a possibility they're not even allowed to do any residential in the area.
Residential demand and approval risk, right? Is anyone familiar with the approval process in London? London has an urban design commission, right? When you hear that word, you know there are a bunch of like 25 architects sitting in a room. Has any two architects ever had a meeting of mind? At least in business you go and you have a meeting of mind, but people when they are very artistic, everybody thinks that they are a better artist than the other. And 25 people sitting together will never have a match of mind. Very difficult. You have to address all the constituencies to get approval, and even then there is that risk. They don't have as of right. Right? What else? To you?
So, if there is any new suppliers in the submarket,
New suppliers?
yeah,
Like who?
like the new residential development in the same area.
Ah, new supply. Okay,
Yeah.
got it. New supply, right? So, okay, what kind of new supply is going on? There is more office coming around here, right? New supply of office. Residential is very limited, but as Nate said, residential is, it's unproven demand. 60% of what they are developing is office. 40% is residential. But in their underwriting, the case tells you that the residential generates 70% of the profits. So, if something goes wrong with the residential, you don't get the approvals, you're not able to sell, for whatever reason. People just don't want to live in the middle of London, for whatever reason, because people's tastes and choices, they want to live somewhere, perhaps in the suburbs. It creates a lot of financial risk. What else? What other kinds of risk? Yes.
Well, interest rate risk. They have a floating rate.
Okay. Interest rate risk. Did you read? I think it's Exhibit 3. Exhibit 3 is where they have given a profile of the debt that they have in the case. Exhibit 5. And one of the things is their LIBOR plus 275 basis points. Right. So, what is the variable in LIBOR plus 275 basis points? The LIBOR. LIBOR could go up significantly, right? Which it did in 2008. What else is the risk? What others are the risks? Anything else? Now, yes, Mr. Shi?
They borrow debt. There's a repayment risk,
Repayment risk,
financial risk,
refinancing risk,
repayment, like to pay back the debt.
pay back the debt. Okay?
Financial risk or like what would risk be?
Repayment of debt. Risk. Right? Because of the timing situation. Okay. So how does time of development and potential delays cause the risk?
More money.
Sorry?
More money. You pay
It may,
interest for that.
because of inflation, the cost of development may go up.
Well,
you may end up with paying more money.
And you pay interest for every, on the debt, every extra month.
So financing cost goes up, okay? And as a consequence of that, what happens? Your returns fall. If your expected return from a project per year is 10%, or let's say 20%, how much would a 1-year delay reduce your IRR by? How much the present value of your deal goes down by by 1 year delay? Yes? How will you think about it?
100 basis points.
100 basis points, right? So your expected return is 20, right?
Oh, well,
So if
sorry.
you were to do it today, this would be this much.
No, I meant 200 in my case.
Right? That will be this would be something like 17%. Your value will decrease, investment value will decrease by 17%. What happens if you do it by 2 years? Your delay is 2 years. How will this change? Roughly 30%. Four years. Roughly 50%. So delay is very, very significant problem. Imagine you are outpost and you are looking at this 8.5 years, no cash coming in, upfront load of cash, uncertainty with the tenant leaving, with the seller leaving, and your project gets delayed. Tremendous risk. And then on top of that, other things with respect to, the approval, things that could cause the delay. Now, as you pointed out, the planning risk. If the city's urban design commission or city decides, mayor's office decides, that they want to build more office rather than commercial, residential, you're done pretty much, right? And you rightly said demand risk for the residential, Nate? That was your intent, right? Demand risk for the residential.
Yeah, it was, yeah.
All, okay? And new partner risk. Currency risk. What is the nature of the currency risk? How would you define characterize currency risk? Obviously, there is a fluctuation between British pound sterling and US dollar. You are a US investor, you have to convert similar, yes,
Multiply both the cost on the front end and the revenue.
and the revenue also, right? So your risk is you translate the money into British pound sterling, and the British pound sterling, what happens to it? Goes up, then your construction costs escalate, right? And when you sell the asset, assuming you complete the asset and you sell it, and your British pound sterling goes down, and then you have to convert it back to the dollar, you can convert to too many dollars. And the funding risk, as Alex said, obviously the volatility of the LIBOR. Okay. Yes.
Sorry, it's potentially a stupid question. Can you explain this little equation right there? When you say delay by 1 year and then you do that?
So if you were to do this today, let's say you make 100,
Yeah.
right? So if you wait for 1 year and you have a 20% expected return, So that would be, the denominator would be 120 and you still make 100 in that year. So there would be a reduction of this 100. 100 is a benchmark. So there'll be a reduction by 17%. There are no stupid questions.
Good question. There's like for India, for example, when developers they construct, they get funding, they build this phase, and then they go out and get more money, and then they build more. How would that work? Like, is that different?
It is different. In not just India, but we will do other case studies, and we will see that in many emerging markets, funding is a problem. So local developers, they are very innovative and they come up with a solution, and the solution is pay as you go. So the buyer of the condo pays up to 50% during the construction phase. Once they acquire acquisition of the property, then they pay the rest of the 50. By that time, the mortgage bank comes into play, right? So for the developer, when they receive the cash, and the cash contribution of that initial 50% is spread out during the construction phase with a 20% down payment, and then certain part of the payment goes to them as the construction gets completed. That's how it works. So that's a very local way of creating time funding from alternate resources to be able to develop, right? Now you could have where the buyer funds your asset, you get to a point you develop, and the mortgage market is not developed. What happens then? Then the developer, you take on that risk, because now they may not be able to pay the 50, and you got the 50, and they own the asset, so you're left with nothing, right? Big problem. So you have to look at both ends of the financing. Now, Baupost has all the capital necessary. They can do the deal as if it is 100% equity. Okay? That could be another consideration when you think about the rate risk. They have a way to deal with the rate risk or the shortfall of financing, if need be. Right? If they did not get the 165 million British pounds sterling financing, they could still have done the deal. Now the question is, for us, how do you mitigate these risks? If you were Baupost and you were the developer, or the Baupost guys who have to make this decision to invest, and you are seeing this risk exposure in front of you, what is that you're going to do to mitigate this? We can go item by item, right? Any thoughts, ideas on any of these items that you could do? Yes, Kevin.
So you want to get the tenant out when they're ready to go out.
Yes.
So I think you can incentivize them by either you have rent that goes up every year. So if they really want to stay there 3 years longer, their rent is just going to be so much more expensive. Or you can have the final sale price on some sort of sliding scale that's a function of how long the lease back period is. So if it goes 3 years later, then you're not getting as much of a sales price. So that way they're incentivized to get out of back to wet fund where they're building a new building.
Incentivize seller to vacate, right?
I don't know if this is possible. Could they renegotiate the price, and instead of giving them all the cash up front like they wanted, maybe give it to them periodically,
Okay, so instead of agreeing to what they're asking for, which is pay all the money up front, you can say structure the deal, payments to meet certain pre-specified milestones, right?
Yep.
To the seller. What would those milestones be?
Maybe approvals, or if they get the the project approved,
Yeah?
then maybe they'll get, I don't know, half, like 50% or something.
Okay.
Thanks,
What else?
Vacating.
Yeah, Taylor?
Vacating.
Okay, so when you get paid when you vacate, right? Upon vacating. If you don't vacate, you don't get paid. You don't vacate timely, Nate, and then, sorry?
This kind of relates to these loans, the approval risk. You could try to structure the contract based on what you ultimately get approved. So maybe you pay them some sort of base, but with a bonus based on whether you get residential or something. So they have basically, they could take a higher purchase price up front, give her a flat price, but if you're confident we're gonna get residential, we'll give you a little bit less now, but if we get residential, we'll pay you far more.
So make them some kind of a partner and incentivize to help you get approvals.
It's probably easier considering they're gonna be nearby to have them on your side as you're going through approvals.
Yes, when you are getting approvals or you want to increase your FAR furthering, who would it make sense? Would it make sense for Baupost to go and argue with the London authorities, or would it be better for Helical Bar to go to argue with the London authorities, or would it be better for the Bart hospital system to go and, right? So perhaps incentivize St. Bart's to in lieu of them securing higher FAR and quick approval. Right? What else? Yes, Brenda.
In terms of the environmental risk, it could be, they can make the owner liable for it. Just like here, you know, when you buy a property, there's some remediations that need to be done. Typically the seller.
The seller to be liable for if they discover something environmental, right? Seller to be made liable for environmental. You could make an argument that we have not really bought it. We will buy it or we acquire it once you have vacated. And as we do our research, if something comes up, then you are responsible for it. That could be a part of the deal. But think about St. Bart's, they're having liquidity issues. They need the money to fund something else. They may or may not agree to it, right? You had your hand up on more before?
Yeah, I was gonna say for currency, I don't know how well this would work, but for them to, because they have the funding, to transfer it like right now so that they're not dealing with any surprises down the road with the currency and inflation.
Currency. And so currency, how will you, how would you mitigate the currency? Will you say that again?
Transfer the money right now so that they're not dealing with any increased fluctuations.
Okay. So you are saying you transfer all your US dollars that you have to make an investment into British pound sterling. Okay, Alex?
I would
Do you agree
say
with that?
No.
Why?
I would say either a forward agreement or an option. Something to, I mean, a forward you would guarantee your exchange rate at different points in time, and the option maybe costs a little bit more upfront, but at least you give yourself some room for some upside.
Okay. What is the problem with the proposition that Anmol made?
Because you have to bring the money back at some point, and there'll
Yes.
still be risk there.
Yes. So the question is, how do you deal with it? What does the case say? How does
I think there's
Baupost deal with currency risk?
I think it was a forward, no? Rolling forward.
That is an option for them, right? How much do you think it costs to hedge your currency risk from British pound sterling to US dollars?
Not much.
Sorry?
Not much.
Not that much?
The pound is not a very volatile currency, neither is the dollar.
Before Brexit, it was not volatile.
Well, yeah, but this is 2011.
Yeah. So yes, 2011. So you could enter into a forward contract where the cost is roughly like 1% or even less, right? So 1%, what does that mean? 1% paid for your FX hedging risk. means that it will take you 100 years to wipe out your capital because you're paying 1% every to hedge their notional amount. Now, are there other ways to manage your currency risk? One of the ways to manage the currency risk is, right, you can't do too much. First of all, you make sure that your amount of equity you deploy is as less as possible now. And then as you need the money, you convert. The other sides of the exposure will always be there, because what happens to, once it has been converted, when you want to bring it back, that exposure will always be there. So perhaps you can start hedging once you start deploying the cash, right? So your incentive would be, in order to avoid incurring the expenditure for the hedging cost as much now, you just push it as much back as possible. What is the ratio of the investment between helical bar and bow post? What is the ratio of equity that they're investing? 2/3 bow post, 1/3 helical bar, right? So how would you think about currency exposure? Are there other ways to think about currency exposure? Yes?
They have helical bar put up in first though.
Yes, you want, first of all, you can have the local financing put in place as best as possible, where they have done it. And if you look at Exhibit 5, it says, under the deal, they have got the approval of 165 million for construction, British pound sterling. And the bank has approved to give you a loan up front of 30 million, British pound sterling. And what you have done is you have structured the deal payments to meet, as Brenda said, certain pre-specified milestones. So you're not paying them up front. You are pushing the outlay of your capital as bow post to later. And you're trying to get the capital as much upfront as possible from these guys. Helical bar, you should put your equity first. Who would put your equity first, helical bar or the bank? Why? Yes, the bank would not let them take the money until helical bar has actually shown that it has put its equity in line, right? So that's one way to do it. And on top of that, you can have an initial structure which says, well, we got most of the money we need up front, and over time we will use the funding, or perhaps bring our cash if we retain the flexibility of bringing the cash in. As we will see several other emerging markets, the cost of hedging foreign exchange risk is 7%, 8%, 10%. For a 10% cost of hedging foreign exchange risk, how soon are you going to burn up all your capital? 10 years, right? You have a 8+ year project, 10 years you're done with it. Very, very careful. What else? What other risks are you going to mitigate? And how so? What other loans? What other risks? Yes?
The new partner risk, you've already mitigated to a certain extent by requiring them to put in a third of equity. But
They have a skin in the game.
But you could also structure the deal, considering they're probably going to be running the approval process. Maybe you give them some kind of deferred return or incentive if they get the approvals done quicker. So that would help you with your partner risk by motivating them, and it would help you with your approval risk.
Okay, align.
And timing.
Absolutely, very good. Align helical bars, upside payments, right? Upside payments to certain milestones. Achieving certain milestones like approvals, like making sure that the project is is finished on time, the construction is finished on time, right? Them being participating along with St. Bart's in the approval process in a timely way. What else? They can also be compensated for achieving sales targets, right? If Helical Bar is ultimately going to be responsible for selling what you're going to build, so you should give them adequate incentives to sell it quickly, and perhaps you can structure all this in some kind of a promote form. Right? What else? What else will you deal with here? What else will you? How else will you mitigate your risks? Yes, Alex.
You get a guaranteed maximum price from your contractor for the construction, although it's pretty far out, so I don't know how you do that.
That's right, and that is the reason why you have so much exposure, right? What else? Should you just incentivize, or should you also put some penalty on it? With the seller, you can have some penalty on it. If you delay, then you pay penalty. With the contractor also, you can put a box around how much you got to pay them, or you can even penalize them if they delay, right? So incentive is not enough. Penalize for delay. And the cost of the penalty should be enough to pinch them. What else? What else? They have financing risk, right? You don't want to take your dollars and convert it into British pound sterling all of a sudden. You have borrowed money domestically, right? And you are, as Alex said, you are exposed because of your interest rate risk. How have Baupost protected themselves? Yes.
It might say this in here, I forget, but I think they might actually be required to buy a cap for their loan.
Yes, they have a cap on their loan, on the interest rate, right?
Yes,
So
right.
LIBOR plus 275, and they can swap it into and cap it, right? Or to a fixed rate, effectively. What else? What are the other risks, and how would you mitigate? You know, Brenda said that you can structure the payments of the deal in a way that they are staggered over time. And let's say you are Baupost and you go and meet with the guys at St. Bart's. What will they say? What will be their first reaction? First reaction, obviously, no, we don't want to do this. We were looking for upfront payment. We need the money. We have to build all these hospitals. We don't have the money. But then you say, you know what, nobody came to buy, you've been trying to sell it, it's been on the market for so long, we think we can help you do this. Right? And what is their response? Maybe even if they agree for the staggered payment, what will they say?
We want lower rent.
Sorry?
We want lower
They
rent.
could want lower rent, so imposing cost upon you, because during that period, they will be continuing to pay the rents. And what Baupost is thinking, the rental payment that will be received will go to pay the interest on the loan that they have borrowed. And there is a period where the loan is interest only. How many years is that? If you look at exhibit 5 or exhibit 3, there is a certain period of time it's interest only. It's a 4-year loan. 3 years you have a prepayment penalty, 4th year there is no prepayment penalty, right, in the last year. there could be a cost because now St. Bart's will say, you know what, you are staggering our payment into the future, so perhaps you give more upside. And as Baupost, you have to be careful that you do not give up too much of your upside going forward. Right? What else would you do to mitigate your risks? Come on, you're going to be the ones who are going to structure these deals. Think about it. Yes, Nate.
I don't know if they let you do this in London, but at home in Toronto, you can do this all the time. Ask to do some preliminary environmental, archaeological, and structural work during the due diligence period prior to going firm on the deal.
Okay,
They
sure.
might not let you, but you can try.
Sure. So make your deal conditional upon not finding anything back, right? Conditionalities.
That's typically in the due diligence period.
Yes, in the due diligence period, or even beyond due diligence period. Means due diligence will be 6 months. You have to do the deal. At some point, you have to lock in this transaction, right? So, but there are certain conditionalities you can leave beyond your due diligence period, as and when they show up. What else? Yes, Taylor.
Pre-sale for the residential portion?
Pre-sales for the residential portion? Yes. Why just residential? Why not office?
I think office.
Huh?
I think office
Sorry.
they were gonna rent, and I think residential was gonna be for sale.
Okay, so that in that sense you're saying pre-sale, you can't pre-sale the condos. Obviously you want the flexibility. Would you not want to have the flexibility? If you are ultimately going to be the owner, the rest of your deal with St. Bart's stays the same. But any time during this deal, you have the right to be able to sell it to a third party and continue to deliver on what contractual commitment to St. Bart's. You want that flexibility, you want that optionality, right? You may want to say, you know what, we need to get out of this deal, and maybe we can sell it, this office space we were contemplating to sell. We have the right to sell. You don't have to sell, but you have the right to sell, even during the phase of the deal, even when the construction may not have started. With the understanding that you will deliver on what you committed to under the big deal with Bart's, St. Bart's. Getting optionality on that process, right? Anything else? Yes, Mr. Shi.
I saw there's the currency risks.
Yeah.
It says the return were measured by the clients on US dollar basis. So can we borrow some debt on the pound, and we just exchange that to the US dollar today and use the return from the projects to pay back that loan?
You could do that, but I think if I'm the bank in England, I would have a problem with you taking money out to pay yourself, right? As a bank, you would want to lock in the payments for specifically the things that you're borrowing the money for. Bank will not allow you to play the game, which is like the Japanese housewives do, which is a canny, right? The canny game where the Japanese interest rates are 0%. They borrow in Japan. And they spend where there is a 8% yield, right? In countries where there is a, like India, 7.5%. So that's a free money trade. That's why Japan is surviving, continues to survive, aside from all the new technology things they have. What else? What else would you do to mitigate these risks? Valuation. You would structure the deal payments, but you have to have a sense of what the total value is. You are a value investor, you are a deep value, you have to have a sense for the intrinsic value of this. Obviously there will be uncertainties, but getting to the valuation, how would you value something like this? Yes, Alex.
One of the measures is price per buildable square foot used.
Yeah.
Or a cap rate, I guess. But I don't know that the rent that St. Bart's is paying is a market rent. I don't know that. So it's hard to come up with a yield or a cap rate based on that.
Yeah, there is some information given in the case for comparable real estate, right? if you look at comparable sites, their valuation ranged from 150 to 300 per buildable square foot.
Right. So you wanna be under 150.
You want to be under 150 because you want to keep the margin of safety, right?
Yeah.
But even if at 150 to 300 range, your valuation would be for 575,000 square feet would be something in the range of 86 to 172 million, in that range, right? Is that analysis sufficient? No? Why? But that would be your first reaction, as I said, right? No. You're saying that may not be that may not be the perfect analysis. Why?
I just think there's a lot more detail that needs to go into every, like, the review of all the transactions, so, like, how are those deals different from yours? What additional risk do you inherit in some of those deals? Like, they talk about price per buildable square foot, but, you know, what if one of those was a parking lot? There's a lot less approval risk, timing risk, et cetera, so it's a good benchmark, but there's a lot more detail you need to look at to make sure you're adjusting for all the risks.
Absolutely, absolutely. You know, this information that is given for these properties is mostly illiquid. This is based on assessments or appraisals rather than actual transaction price data, right? So that could be an issue. They have given you cash flow projections. What do you think of the cash flow projections?
It's a base case, so.
They don't include the purchase price, but, okay, but they have a sale price in there. And the cash outflow effectively tells you what the purchase price is, right? Because there is a sequence of payments to them. If you add that all up,
Is that in the development costs?
it should be on the cash flow statement.
But it just says development costs and not payments to seller.
That excluded land.
Right.
Okay, okay. So typically what you would do is, you would do if you're bow post, you want to get unlevered cash flows, right? Unlevered cash flows in the absence of debt, in the absence of interest paid, debt, closing costs and other things, anything related to debt when you strip out, whatever is your total unlevered development cost. And what is the UK tax rate?
20%?
So during the first phase, there would be, when you are spending money on an annual basis, you would have some loss. Right? How do you deal with the losses? So there may be some advantage of carrying forward the loss also. And assuming you get to your set of cash flows, unlevered cash flows, what is the next step you will do? The next step is to find the
Error.
You could find the IRR. You could use a discount rate, right? How would you find the discount rate? What are some of the ways you can think about the discount rate? Or what you can say supposedly your expected rate of return. There is information given in the case which deals with the US returns. That doesn't say about UK returns. So we'll use for now the proxy and we will see what would have happened when the UK returns are considered and when the US returns are considered, right? So assuming you would normally use US returns in this case. In the last discussion we saw that the risk-free rate, you have to choose a risk-free rate. It is the US risk-free rate or the British pound sterling risk-free rate, right? That would depend on what? That would depend on whether you are, a couple of factors. Whether you're converting, and if you're not converting, then should this be the US risk-free rate or should be the London risk-free rate?
What do you mean if you're not converting? If you're not converting from US to
You're not converting your dollars into British pound sterling. The moment you convert, then you have to use the domestic risk rate. Because the logic is, if you are taking your money into a country, into England or France, you would not take money into that country unless you get at least the risk-free return that you would get in that country. Because now your investment becomes into, used to be French franc, British pound sterling. Okay. And this is like a situation where there is not too much of a difference between the two. You could have a situation where you go to China or you go to Thailand for a development. Those differences could be very high. Okay. During this period, the 8-year bond yield in the UK in 2011 was approximately 3.4%. What else how would you calculate the rest? Right? This information is there. Relatively easy because this is 3.4%. Would you be able to calculate the return on market in the UK? Yes? No? How would you calculate the return on the market in the UK? How would you calculate it in the US? Return?
Index maybe?
Which index?
In the US, S&P 500.
Okay, and in UK?
FTSE?
FTSE. Exactly right. Right. Now, what should be your beta? How would you get to your beta? There is information given in your exhibit, right? Beta is the covariance. And who remembers from corporate finance the relation, how is covariance calculated? Beta of X and Y, X is the security, the real estate, and Y is the market, is what? Beta of X and Y is equal to what?
Delta X over delta.
Delta X over delta. Oh, that's based on the diagram, right? On the regression line.
Yeah.
No. There's a formula, the covariance formula. What is the covariance formula? Correlation of XY times sigma of Y divided by sigma of X. This is the volatility of X and Y, and this is the correlation. Correlation is given 0.14. Right? What about the sigma? Is the volatility given? If you look at, for NICREIF it is 7.62 and for S&P 500 it is 16.46. What is that for S&P 500? Exhibit?
16.46.
16.46. And this turns out to be? .6, 0.7. Say for example. Does that tell you anything? Doesn't tell you much. Why? Because you would expect, this is basically beta is 0. What does 0 beta mean?
No.
Low correlation.
Very, very, very low correlation. Right? But macroeconomic factors do affect real estate, so there has to be more correlation than another way to think about this is as follows. This beta effectively measures how the change in this is affected by the change in the other, right? So if you are an investor in a foreign market, you can confirm, if you can look at the history of the market returns of the equity of the UK market relative to the US market, and you can say the ratio between the two, that could be the beta. And here the case gives you something which is basically during the maximum point of global financial crisis, in the time period between Q3 of 2007 and Q1 of 2009, the S&P fell by 45.4%. Right? Exhibit 1. Look at Exhibit 1. And during the same time, the NCREIF index fell by 23.9%. Almost the same time, but slight lag. Q2 2008 to Q4 2009. So if beta measures how one behaves relative to the other, you could take the ratio of 23.9 and 45.4 and come up with some number, which is 0.53. It is like basically saying the word is drawdown. If you look at Exhibit 1 of your case, drawdown measures the greatest peak to trough loss experienced over that time. Yes, Carter?
Why don't you do it for the average returns instead?
You could. But if you are looking at extreme situations, what was that ratio, right? And based on the data given, you can take that ratio to be 0.53. Now you have beta of 0.53, right? So expected return will be 3.4% plus 0.53 times RM minus RF, 3.4% minus, what is the risk to return on market?
Or is it negative 23.4?
What is the difference between that and the risk-free rate? Roughly 5%. I don't know where I have 5% here in my case. So whatever that number is, right? If this whole number is 5%, this number is called market risk premium, right? This part, RM minus RF is the market risk premium. So this gives you what? Roughly 6.1%. This is another way to do it. Is this adequate? Probably not. So what do you do? What else can you do? Yes, Nate.
Sure, just want to go back for 1 sec really quickly. What were the two numbers you used to calculate the ratio of 0.53?
That is the drawdowns. Maximum drawdown in the middle table on Exhibit 1. 23.9%, right? Divided by. So that's what your assumption would be to compare the drawdown. This was Carter's question actually. Maximum drawdowns. In the worst case scenario, how do they correlate? Yes.
Well, I wasn't going to answer that, but in this situation, when you're taking the market return, were you using the NCREIF as a market return to get to 5%?
But I just assumed a 5% market risk premium.
Because that sounds like a core real estate asset.
No. Market risk premium has nothing to do with core real estate. Market risk premium, what is market risk premium? This would be the FTSE minus the 3.4. Or S&P 500 minus the treasury, right? That is the market risk premium.
I'm not talking about the premium, I'm talking about the total expected return.
This one, right?
Yeah.
So we are trying to calculate that based on some assumption here.
Right.
And market risk premium, I just assumed 5%. in the US, on the long run, market risk premium has been from 4% to 8.5%.
No, that's not what I was saying. I meant, if we get to 6.1, that doesn't sound right. Because this
Sounds
is,
low.
because this is an incredibly risky transaction.
Right, right. So what do you do? What do you do?
Call it 30%. There you go.
Yes, you could. You could randomly call 30%, but you have to think through, right? How do you develop it? There has to be a process of thinking about it. Because you may be, if you have a 30% hurdle, you may never do the deal. The deal may never happen because the price differential between what you want to pay, because of 30% discount rate, your value becomes so low that you are not even able to structure the deal. Other party will think you're crazy. You should have a way to converse about how you thought about what kind of a return you can expect. So you can build this up. Perhaps you can build up something else on top of it, some delta for illiquidity risk or some size risk, right? Delta 1, delta 2. For market risk, when you do a cash flow analysis, a discounted cash flow analysis, you have value is equal to cash flow 1 divided by 1 plus R1 plus cash flow 2 divided by 1 plus R2 plus cash flow n divided by 1 plus R to the power n, right? Plus you can add here in the last plus sale price. Okay. That is the value you will be willing to pay. So you can, if you're a value investor, typically what you do is you build out the cash flow because that's how it gets to your real intrinsic value. The value of the cash flow is the intrinsic value. And you can make the adjustment in what you call the margin of safety by taking a reasonably conservative discount rate. So when you are building this pro forma, what should be the top line? How would you think, what does your cash flow represent? What kind of risk does it reflect? It reflects the idiosyncratic risk of your business, right? Because it is specific to your property and you are saying based on the leases I have and the potential leases I can have and how much I spend, this is the cash flow I will have from period to period, which is related just to my business. But what happens to the denominator? What does the denominator capture? What should it capture? We've studied in corporate finance and we've studied in real estate finance. The 1 plus R captures what? It should capture what? The market risk. It should include the market risk. Not just the idiosyncratic risk of your project, but also the market risk. So you now have to compartmentalize your thought when you're doing any DCF analysis. What does my numerator represent, and what does my denominator represent? Am I being too aggressive because I did not include the market risk in my denominator? Or if I included market risk factors which are very unique to my business, which I have to include in my cash flows, then what is the discount rate I use, whether it has to be purely idiosyncratic or it still is the market risk. Typically it's still the market risk. And that's how you get to some value. And Alex, your thought is right. Perhaps you pressure it so much, you put the delta, you build upon this and you hit, let's say, because of all this, you get to a point, piece by piece by piece. I expect this much premium for the fact that my delay would be 5 years. I have mitigated as a margin of safety investor. I have structured this in a way where I can extract the margin of safety from each of the elements. By structuring payments in a delayed form, you are effectively doing what? You're trying to create a margin of safety for yourself, right? So for any investment situation, Your genius is to construct a margin of safety through the structure of the deal. Piece by piece by piece by piece. And then make sure to reflect in the denominator the market risk that would be applied to this, which is, or the discount rate. Right? That's how you get to your intrinsic valuation. All right. Do you want to know what happened? Huh? But there's a lot of very rich discussion we can't have today. We'll continue to have next classes. If you were to develop a framework for investing, an original framework for investing, how would you do it? Right? We will go through all those things. It's pretty fascinating. Now, let me pick up my notes here. So this is what I was told by the team. For the baupost, the margin of safety comes primarily in the form of low basis, low cash outlay. But if they do it certain way, there's also ways you can improve upon that. Depends on how you think about it. And my personal view is the entire structure should give you a margin of safety. You have to construct the entire structure, creating pieces of margin of safety. If baupost got interested in this because of the limited buyer pool, they don't want to go and participate in an auction. Helical had an excellent relationship with the City of London. They ended up doing phased payments, as Brenda said. Upfront payments plus back-end payment and future upside for the hospital for more density. If St. Bart's could get them more density, they paid them more. It allowed for the delay of the capital outlay. Eliminated any of the incentives on part of the hospital to obstruct the project. They eliminated any incentives on part of the hospital to delay the project. So basically, in fact, they put some penalty on it. And they induced the hospital to vouch on their behalf with the City of London. And the delayed development did allow them for some flexibility to do all the detailed due diligence and come up with the designs, and very thought out, because these are complex structures. You're not going to, it's a historic development. So you really have to very thoughtfully, it gives you time to come up with what detailed working drawings and construction drawings. And they created optionality around the exit. What was the optionality? We get into this deal today. We have made partial payments to you under this master agreement that we have with you. But there is nothing in it that limits us from actually being able to sell it to a third party. Exactly how Blackstone did with equity office properties. Remember that deal? Does anyone remember? Just before the crisis in 2007, Blackstone acquired equity office from Sam Zell. Paid a hefty price. Luckily for them, what they had done before they bought it, they had already sold the parcels out to different people who were interested in different pieces. So the sum of the parts was greater than what they acquired it for. And that is why Blackstone survived. If Blackstone had not been so astute to do that, then they would have ended up holding a basket of this thing. Right? They do still hold equity. Actually, it's funny. One of my very good friends is now the CEO of Equity Office. She was my classmate at MIT, Lisa Picard. She had a unique path. She went through development and then she joined Equity Office. And then from Equity Office, she came to Blackstone. And in Blackstone, one day, Jonathan Gray basically said, could you want to be the CEO? She said, let me think about it. Maybe I'll invite her, not this class, but maybe in the spring I'll invite her here to speak to my students. It'll be fun. And by the way, the Ardia guy, I told you about Ardia, right? Ardia guy? Abu Dhabi Investment Authority, former head of Abu Dhabi. He cannot do it in the fall. He will come and speak in the spring, but you will all be invited in the spring. He'll be a wonderful person to meet. His name is Bill Shaw. He's So anyway, continuing. So the total sale price upon exit was 400 million. They were able to sell early using the option to sell. Returns were bootstrapped because of this optionality. They did not worry about currency risk because they took local financing. As long as the market value was hedged back to the US dollar, Baupost were okay with it. They were hands off on design. Helical was largely office development company, so the office development went well. For residents, Helical depended too much on their architect and the costs went over budget. In 2011, Baupost was playing the distress cycle in London. The site plan in the case does not accurately reflect what got built. That's in the case, right? It didn't. So an office building was built first and sold, and all the money was recovered, and then only owned residential was sold off as condos. So generally, Baupost looks for best risk-adjusted returns. 20 to 50% of their cash position at all times, 20 to 50% is in cash. Not every investment has to be as good as Baupost's best investment. So they don't get caught up into being willing to replicate the post-perfect deal that they did before. They deal with uncertainties and they understand risk. As long as they understand and they convince that there is a margin of safety, they do the deal. And they only focus on investments where it's extremely hard to lose money. Principal protection. And they are always interested in buying cash flows on the cheap. In 2011, they bought a lot of residential land and underwrote in a depressed market and benefited from the recovery. They always underwrite unlevered. Okay? If you're levered, this is I keep saying, if your deal works on an unlevered basis and you have enough margin of safety there, then leverage will only do magic for you, especially if you're the promoter. 80 to 90% of the profits, rather than 30% that they had initially underwrote, came from the office buildings. The residential costs exceeded as a result of the second largest contractor in the UK, Corillion, went bankrupt last year. This impacted the St. Bart's project up to a tune of 10 to 20 million British pounds sterling. It was negative impact. Residential was built at 1300 per square foot and sold at 1500 per square foot. High-end residential in London is in distress right now, for obvious reasons, self-inflicted reasons. Corillion went bankrupt, and apparently these guys owned 8 million pounds sterling. So I asked him, what did you do? Did you pay them? Because under bankruptcy, they may have a claim. He said, no, we didn't, because we didn't want to, we didn't raise it, didn't care. They focus on long-term risk-adjusted returns, don't have any target returns, but focused on margin of safety. Baupost recycles capital from the same investors, and they are both IRR and multiple focused. They have no allocation to a fixed asset class. They are extremely versatile and look for opportunities. Today, their view is that the market is so expensive that allocation to real estate has become a lot lower. They do not hedge forward cash flows. First equity check was 30 million. Debt finance hedged it. May not hedge the profit, but hedge the operating exposure. So they are not really worried about how much they will end up in the profit on the back end, right? So they don't get into that hedge. And they prefer long duration investments. Okay? So next class, I'm sorry we went over time. My apologies, yes.
Do you know what they ended up paying for the land, the total?
Less than 150.
On top of the development cost?
No. The development cost was the top of it, no?
Well, the projection doesn't make that clear. It says it's development cost, but it doesn't allocate any of it to the land. So I
So
thought,
the acquisition price was in the range, on the lower end of that range of 150,
but
and
it was in that range.
it was lower on the lower side of that.
Wow.
Yeah. And plus it was spread out over time.
I thought it had to be a lot lower.
The first down payment was 55 million sterling.
What?
Yeah.
I didn't know that.
So those all preferred.
Yeah, I saw it online.
Oh, that's what I had.
Yeah.
So anyway, I'll show you, before we start the next class, I'll show you how the project looks now. Okay? Now, next class, there will be no class on Sunday, there will be class on Thursday. And we will discuss Equity International, which is a fascinating discussion. Now, what I would urge you to do is, between now and next Thursday, because you're getting Sunday free, to think about your project that you're going to do, develop that project. Did I give you how to write the synopsis of the project? Some guidelines? Please use that and develop a one-page synopsis to submit to me next Thursday. Okay? And then we will then go around and have another conversation. Great.